What's going on, guys, and welcome back to another stock analysis video. And today we are going to be running through Alphabet, which of course is the parent company of Google. Now, in order to do that, we're going to split this video into three distinct segments. The first of those being a historical financial review. Then we're going to look at the future prospects for the business. And then finally, we're going to come on to the valuation using an earnings multiple and discounted cash flow model. So the first of those is the review of the historical financial performance of the business, where I like to try and analyze how the business has fared over the last 5 years against my 6 key metrics. And those key metrics are revenue growth, earnings growth being EBITDA and net income growth, free cash flow growth. I like to see an interest cover which is greater than 2. I like to see a return on invested capital greater than 10%. And then lastly, I like to see shares outstanding at least stable, but preferably reducing over that time period. Now, in my opinion, these 6 key metrics are strong indicators of a financially sound business, and therefore I start to get interested if they tick off all of the boxes. So without further ado, let's jump over to the computer and see how we're getting on. But just before we dive into the financial analysis of the business, let's take a look at what the market is currently pricing Alphabet at, right? So we've got a 52-week high here of $2,900. And really, we're just more or less at that right now. So $2,800 at the moment. We've got 52-week lows at $1,465. That gives it a current market capitalization of $1.8 trillion. So clearly, it's one of the big 5 tech companies. It's an absolute behemoth, and we don't see it going anywhere soon. And that's reflected in the short interest, right? So there's only 0.41% of total shares outstanding, which are currently short. And there's no surprise there, because who would bet against Google, right? So very expensive company. It's one of the staples in the S&P 500. And so there's no surprises there. But let's have a look in the financial performance of the business. So as I said earlier on, metric number 1 is revenue growth. And clearly Alphabet does not struggle here, right? So in 2016, or at the end of 2016, they generated revenues of $90 billion. You fast forward to 2020, and they achieved revenues of $182 billion. So over that 4-year period, they have managed to double their revenues. So clearly they're not struggling for revenue growth, and they get a big check mark there. Metric number 2 is earnings growth, and that is represented by EBITDA and net income. So we can see EBITDA here in blue. That went from $29.8 billion in 2016 right the way up to $55 billion in 2020. So very solid performance there. Similarly with net income, we went from $20 billion in 2016 right the way up to $40 billion in 2020. So a strong check mark against the earnings growth, and that's 2 out of 2 so far. The metric number 3 is free cash flow growth. Now, admittedly, this doesn't look as solid as the revenue and earnings growth, but nonetheless, we're still looking at a check mark here, right? Still a big tick against that metric. So in 2016, we went from free cash flow per share of $38, and that has risen to $63 at the end of 2020. So still very solid numbers, but we can see here in the middle where free cash flow growth didn't quite keep up with earnings and revenue growth. So that's just something to bear in mind. But at the end of the day, they've gone from $38 per share in 2016 right the way up to $63 per share in 2020. So it's still solid growth and still a tick against that metric. Now, metric number 4 is interest cover, right? And the whole point of this analysis is to try and see whether the company's earnings are more than sufficient to cover the amount of interest that they have to pay on their debt, right? And we can see here, I like to look for something which is at least greater than 2. So 2 is an absolute minimum, right? So their earnings or their profits have to be greater than 2 times their interest payments, right? We can see here for Google, we've got an EBIT over interest expense of 191, and that goes all the way up to 305, right? So in other words, their profits are 305 times greater than the amount of interest expense that they have to pay. So there's absolutely no concern here from a balance sheet perspective on whether they can manage to pay down that debt. And the metric number 5 is return on invested capital, right? So this is effectively where we're looking at all of the money which has been invested in the business. What return are they actually generating with that capital, right? So, and I like to look for something which is at least 10% or higher, particularly for a mature company. And we can see here that although it looks quite drastic and it looks like it's been sort of a significant decline over the last few years, it's still been at least 16% year over year. So that is a solid return on invested capital, and therefore investors are going to be willing to pay a premium for a stock of this caliber. And then the 6th and final metric is total shares outstanding. Now, generally speaking, we want to see these shares decreasing over time, as it shows that a company is buying back their own shares and therefore increasing our total proportion of the entire company. Now, there are certain circumstances where actually it makes a lot of sense for a company to be issuing new shares, particularly if the company is trading at high multiples and is currently appears to be overvalued. They can actually take advantage of that, issue new shares, get the cash, and then invest that within the business, right? So this isn't sort of a clear-cut sort of metric to use, but generally speaking, we want to see a decline in the shares outstanding. Now, in the case of Alphabet, we can see that their total shares outstanding have gone from 691 million in 2016 right the way down to 674 million at the end of 2020. So clearly Alphabet are buying back their own shares, which is good to see as it increases the shareholders' total equity within the business. So out of the 6 key metrics, Alphabet has managed to achieve a check mark against every single one of them. So clearly, historically, Alphabet has been performing very well. And you can see that the revenue percentage change here, right? So 20%, 22%, 23%, 18%, 13%. And then I think in 2021, we're looking at something like 35%, right? So clearly, financially, historically, they've done very well. But what is going to be the driver of growth for the future? Now, I think one of the projects which has the most amount of potential for Google or Alphabet is the company that they own, which is Waymo. Now, this is effectively a project that they're working on for autonomous driving, and I think that this could be huge for the future, right? So we're talking about autonomous delivery vehicles, whether that be vehicles delivering packages within the city or lorries on the highway, for example. But either way, there is a huge potential market for this, right? And I think a lot of people give credit and attention to Tesla for their potential in self-driving. But I think that not many people pay attention to Waymo and the fact that actually Google owns Waymo. And if this does become successful for them, they are going to reap the benefits of that. Now, clearly there's a huge incentive, not just financially for the businesses themselves, so for Waymo and Tesla, for example, but also for the governments from a safety perspective, right? So you can see here that there are 1.35 million deaths worldwide due to vehicle crashes every year, and 36,000 road deaths in the US in 2019, right? And 94% of crashes involve human error in the US, right? So clearly if autonomous driving can be cracked in the future, then that will be absolutely huge. And I also think that the companies that are trying to achieve this will get a lot of support as well, both from governments and also from other organizations, right? So there's definitely huge incentive. I think this is probably many, many years away from being rolled out, if I'm being honest. From the research that I've done, I don't think we're anywhere near sort of like 2 or 3 years close to sort of achieving this, but certainly 10, 15 years from now, I can see this actually being a reality. So that's definitely going to be a significant driver for growth for Alphabet if they can achieve it. Now, in terms of why Waymo might actually be able to achieve this, right? Well, first of all, they're a subsidiary of Alphabet, right? So they have access to a huge amount of data, which is obviously beneficial for somebody trying to create all of the necessary algorithms for something like this to work, right? So that's number one. Secondly, Alphabet has cash and cash equivalents of $135 billion, right? $135 billion of cash ready to effectively use and invest where we see the opportunities. And therefore, a large amount of that cash balance can go into research and development, which will hopefully allow them to achieve that goal. Now, this article from the Motley Fool summarizes this quite nicely, right? So it says that if Waymo does pay off, it could pay off big. The harder a technology is to get right and the greater the amount of investment required, the higher the barriers to entry are for that service. As an early mover with over $100 billion in cash, Alphabet is bound to be one of the last men standing if the self-driving technology catches up with the hype. If that happens, Alphabet will still own a large portion of what will likely be a highly competitively advantaged service. Not only that, it doesn't seem like the market is particularly giving too much weighting to Waymo at the moment, which means if it does pay off in the future, you're effectively getting that for free, right? So it reads here, in another positive for shareholders, it doesn't appear the market is giving much value to the Waymo unit anyway. Alphabet's core businesses in digital advertising and cloud computing can easily justify its market cap today, at least in this shareholder's humble opinion, right? So that was according to the writer of the article. And to be fair, I would probably agree with them, and we'll go into why that might be in my valuation later on. Now, another large driver for growth, in my opinion, for Alphabet is YouTube, right? So you're watching this video on YouTube right now, and I think that the business model of YouTube is second to none. But in terms of revenues, right, we've got revenues in 2018 of $11 billion. That increased by about 40% to $15 billion in 2019. And that increased a further sort of 30% to around $20 billion in 2020. So the growth of, YouTube is significant, and it's much larger than the growth of the sort of total Alphabet group as a whole. And I think this is going to be a key driver for growth. Now, if we compare the revenue of YouTube to other streaming services such as Netflix, right? So in 2020, YouTube's revenue was $20 billion. And if we go across to Netflix, their revenue in 2020 was $25 billion, right? So around 25% larger. So Netflix is valued at $280 billion. Here's the thing though, right? Netflix has huge amount of expenditure just by the nature of the business. So if we compare the two, we've got Google or YouTube, which effectively people like me and other people, other content creators, upload videos, and that doesn't cost YouTube much at all. And then for the people that are monetized, there are adverts on there, and that's how they generate revenues, right? So there's not a significant amount of outlay for YouTube. We compare that with Netflix, where they have to create various different programs, different series, different films, and that has a massive amount of expenditure. So effectively, content is being uploaded to YouTube for free, right? Compared with Netflix, who have to put a significant amount of work to actually create their content. Now that represents itself in the gross margins, right? So we can see for gross margins for Netflix, we've got around 38 or 39%. And in terms of net income margins, it's around 9, 10 or 11%, right? Now we don't have the gross margins, we don't have the profitability of YouTube, but I suspect that it's much higher than that. I think that the gross margins of YouTube are probably 60 or even 70%. And I think that they're probably operating on a net income margin of something closer to 30%. So I think that the profitability of YouTube compared with Netflix is much higher. Not only that, right, but the growth of YouTube is currently higher than the growth of Netflix. So in 2019, Netflix recorded revenue growth of 27%, and in 2020 it was 24%. Now you compare that to what we said with YouTube, where it was around 40% and then 30%. YouTube is growing at a greater rate. And the reason I say all of that is because of this, right? The current market capitalization of Netflix is around $280 billion. Now, of course, Alphabet has a current market capitalization of $1.8 trillion. But I think that if YouTube was a standalone entity, I think that its market capitalization would be much larger than the Netflix capitalization, right? So Netflix is $280 billion. I think that YouTube would be able to command a price to sales ratio at the moment of around 20 or just under that. And that would give them a market capitalization of around $400 billion. And that's because of their profitability, right? Their business model is fantastic. I think it's better than Netflix's, and so it would have a significant market cap. So I think that there's a lot of value within YouTube for Alphabet that we're probably not really realizing to the full extent. So then that brings us on to my valuation for the business right now. Of course, 2021 is almost complete. We've had half-year results so far, and therefore we can take a certain amount of reliability from the estimates that we've got here from analysts, right? So for 2021, we're expecting revenues of $251 billion. That'd be a 37.5% growth. And for 2022, we're expecting $293 billion, and that would be a 17% growth, right? So I've input those into my financial model, and you can see those over here. And then for 3 to 5 year revenue growth, I've gone for 17%. Now, the reason I've used 17% is because in 2022, analysts were expecting 17% revenue growth, and I think it's fair to assume that Alphabet can maintain that level of growth, right? So they're a complete staple. Everybody needs their advertising services effectively, and I think that 17% revenue growth for the next 3 years is more than achievable for Alphabet. Then we go on to 6 to 10 year revenue growth, and I actually dropped that back slightly just by nature of the fact that the company is getting larger and larger. So then we go down to revenue growth of 13%. In terms of gross margins, I've just taken the average of the last 5 years, and luckily they haven't fluctuated too much, right? So we can take a fair amount of reliability from that. Operating expenses, similarly, same argument effectively. Average of the last 5 years, and that's around 32%. We go to weighted average cost of capital, and that is 9.1%. There's a calculation there. If you want to, you can pause the video and take a look. We also take into account the fact that they've got $135 billion of cash and just $26 billion of debt on their balance sheet. When we then look at their forecasted results, right, we're expecting that in 2030, they're going to be achieving revenues of $865 billion. You compare that to what we're expecting in 2021 of $251 billion. Clearly, this is growing at a very good rate. Similarly, for profit after tax, so in 2020, it was just $40 billion. In 2021, I'm expecting around $60 billion. At the end of 2030, I'm expecting them to be having profits every year of $202 billion. So absolutely huge amount of profits there, but I think that it's more than reasonable. We go across to the discounted cash flow, and we can see the inputs here. So what I've done is I've calculated what their unlevered free cash flow is as a percentage of their EBITDA, and then effectively I've extrapolated that out to the future, right? And we can see here, this is the EBITDA that we're expecting year over year. Below here is the unlevered free cash flow, which is based on the fact that I'm expecting unlevered free cash flow as a percentage of EBITDA to be around 48%, right? And then we can see here, and then we take the present value of those future cash flows by multiplying by the discount rate. Now that discount rate, of course, is based on the weighted average cost of capital, which I alluded to earlier on. Now, based on the discounted cash flow, that brings us to an intrinsic value per share of around $2,100. And if we go to the multiple of earnings model, so we're taking those earnings in 10 years time, which is $202 billion, and I'm multiplying by a PE ratio of 20. I think that for this kind of business, you're always going to pay a premium, despite the fact that in 10 years time, it will be growing slower. So I think that 20 PE multiple is more than fair. That gets us to a price per share in 10 years time of $6,000. We bring that back down to what it is worth today, and it's around $2,700. We take the average of the two so that we're not swayed either way, and we get a fair value per share at the moment, or I believe around $2,400 for this stock. That means a negative margin of safety of around 14%. So in my opinion, it does appear to be overvalued at today's price. But anyway, that's what we think that it is worth today. What do we think that this stock could be worth in 5 years' time? Now, in order to determine a 2025 price target for this business, we use an enterprise value to EBITDA multiple. So we think that in 2025, the EBITDA is going to be $146 billion, and that's based on all of the assumptions that we've already run through. I've then applied an enterprise value to EBITDA multiple of 16. Now, in terms of where I've come up with that number, effectively what I've done is I've had a look at what the multiple has been on average over the last 5 years, and we can see that it's been just under 19, right? It's been as low as 13, but in fairness, that was following the COVID crash, right? So we can pretty much exclude that. Currently, it's trading at around 23 times EBITDA. I think, right, that given the sort of current macroeconomic environment, and given the fact that the vast majority of stocks are trading at pretty much all-time highs in terms of both the price, but also multiples as well, I think that using 19 might be a little bit too bullish, right, or just below 19. So I've gone with a conservative approach and I've used 16, right, a multiple of 16. We can take a look at what the price might be if we apply the average of 19 and see how it changes, right? But effectively, an enterprise value to EBITDA multiple of 16. I've then taken into account the fact that they are buying back their shares every year. So I've said that every year they're going to buy back 1% of their shares, which is pretty much in line with what they've been doing historically. That gives us a 2025 price target of $3,800 and a compounded annual growth rate of just 7%, which of course is not great, right? But like I said, this is a stock that is trading at all-time highs, both in terms of its price, but also in terms of the multiples that investors are currently paying for the stock. Now, are investors always going to be willing to pay these extremely high multiples that they're paying at the moment? I don't know. Maybe they will, maybe they won't. In this instance, we've only used an enterprise value to EBITDA multiple of 16. If we increase that to the historical average over the last 5 years, we get a 2025 price target of $4,500, which would be a compounded annual growth rate of 11%, which is somewhat better, of course. If we was to increase that even further to what the multiple is today, right, we're looking at a compounded annual growth rate of 16.5%, right? And that's based on a share price of $5,500 or $5,400. The thing that you have to ask yourself is, do you believe that investors are going to continue to pay premiums for stocks based on or compared to historical averages? Or do you think that those multiples are going to effectively be reined in, right? So I always prefer to take a prudent approach. And so this is the figure, not one. This is the figure that I would go with, right? $3,800 by 2025. Anyway, guys, I hope you found the video useful. And until next time, thank you.